Hey everybody, it is Hammer Helmer here with your vetted VA mortgage market update this week. I've got two guests with us this week, and we are here, of course, on September 21st. We've got two guests. We got Michael Dendy and all of a sudden I blank on it, right? Rodil San Mateo. So if you don't mind going ahead and introduce yourselves, tell us a little bit about yourselves. Let's start with Michael since I've got you right next to me there. We'll start with you first. Go ahead.
All right, I'm Michael Dendy. I'm in the Tennessee market. I'm both a real estate agent and a mortgage loan officer. So I've been doing this, the mortgages for 5 years, been working, I would say 40–50% of my business is definitely in the veteran category. We're here close to Clarksville, which is actually Fort Campbell. So work a lot with veterans there coming in and out of Fort Campbell, and yeah, I like serving veterans. It's a good role to be in. Everything comes down to how can we best serve, educate, and make sure that a veteran home buyer is completely aware of exactly what they're getting, both from a loan perspective and from a real estate perspective.
Awesome. Well, thank you for joining us. And Rodil, please go ahead and tell us about yourself. Introduce yourself.
Hi, Rodil San Mateo here. I'm located in the San Francisco Bay Area, specifically the East Bay. I've been a loan officer since 2005, and we have one very large military base just north of us in Solano County, Travis Air Force Base. And I've been a member of vetted VA about just over a year now, and like Michael said, it's a great resource and really helps real estate professionals and veterans who are looking to buy a home become more educated in the process, and really to have a team behind you to give you information on how all this works.
Awesome. Well, thank you both for joining us this week. Remember, y'all, if you're watching and you're here live, please take a minute and let us know you're here. Give us a hashtag live. If you're not already given StreamYard permission to show your name, let us know who you are. You can click the link in the post somewhere about giving StreamYard permission for showing who you are. But remember, be a part of the conversation, ask questions, share your thoughts. We have a lot to talk about today. Some really interesting things going on. We've got a Fed meeting going on today. We have rates that have moved up very dramatically in a relatively short period of time. We're going to talk about why that's happened, where we think things are going to go next, and kind of what you should do as a consumer with this rate increase. You know, when you see rates go up, it's a question that we see a lot right now. So we'll be talking about that. If you're watching on the replay, do me a favor and give us a hashtag replay. We want to know that this is helping y'all. We know that you can't be here every week. And, but if you are watching on the replay, it's important for us to know that we are serving you. So we do monitor this post. You can also go ahead and ask any questions, you know, pretend you're watching it live, answer the questions we ask you, and ask us any questions along the way. We'll make sure we answer them and share any of your thoughts as well. So with all of that said, let's kind of talk about a little bit about where rates have gone, where they've been, and what's kind of happened over the last few weeks. So let's go back to July. So July, we had some of the best mortgage rates that we've seen. I'm going to say in 2022. Does that sound right to you guys, Michael and Rodil? Does that sound, 20, like when we saw rates kind of in the low fives for a lot of loans, maybe even high fours for some VA lenders, VA scenarios. Was that in July when you guys saw rates like that?
Yeah, there was definitely a slight dip when we got back into July, for sure.
Yeah. Rodil, did you see that as well?
Yeah. Saw that here too. And then, as you know, the last 4 or 5 weeks have been a real roller coaster, at least on the upslope.
Yeah, absolutely. And let's talk about what's happened and why. So rates have definitely moved up significantly in the last, we'll call it, 6 weeks. And for me, I think the best analogy that I have for what's happened is a frog in a boiling pot. I don't know if anyone's ever heard the story, but if you put a frog in a pot of cold water, they always, the wives' tale or the myth is that if you put the pot on and as it gets warmer, the frog won't jump out of the pot of water because it doesn't feel that gradual heat increasing. And by the time the pot is boiling and the frog, of course, boiling with it, it's too late and the frog can't get out. And I feel like that has been where where a lot of consumers, a lot of loan officers have been the last, let's call it the last month, the last 6 weeks, and especially myself, because I counsel everybody each week. I come on these calls and I say, hey, don't panic. We're going to see things drop back down. And, basically everyone's kind of been like, psh, Hammer always says that. And it hasn't happened. We haven't seen rates go back down. And I kind of want to just talk a little bit about why rates have moved up and why we haven't seen them go down, even though, I expected to see them improve. And then we're going to talk about today's Fed meeting. So the first thing is that, rates have moved up over the last 6 weeks. For, again, anytime that we talk about actual numbers, remember that your unique situation is going to, to give you a specific rate. So even though we're giving ranges, just to give everybody an idea, you really do need to make sure you're working with a professional and you see what your rate quote would be. But I mean, people that may have seen a rate in the high fours at the end of July, they could possibly be looking at the high fives or even the low sixes right now. So we've seen what would equate to basically a full 1% increase in mortgage rates in about 6 weeks. Does that sound about right to you guys, Michael and Rodil? Does that sound about a point as a rough average? Would you guys agree with that?
Yeah, definitely.
All right.
Yes, that's about the range I've seen also.
Okay, cool. And through that time, I've been one that's been forecasting that I thought rates would get better. And I said, hey, let's push through this. We're going to see things come down. Now, the reason that I said that and what we've expected to see happen, I'm going to go ahead and pop the screen back up and kind of show everybody a little bit. So, let me just go to a fresh page here, and there you go. So coming here, the reason that we expected to see rates kind of improve after seeing them work their way up is, remember, there's been two horses, and I can't draw horses. So I'm just going to draw two arrows, and pushing rates up has been fear of inflation. And I've talked about this on some of the other calls, if you guys might have seen it, or if not. Fear of inflation pushes mortgage rates higher because inflation in and of itself is bad for mortgage rates. Let's talk about a quick, thing. Why is inflation bad for mortgage rates? Basically, the idea here, to understand why inflation is bad, you need to understand where mortgage rates come from. You as a consumer, you want to buy a home or you're looking to refinance this house, but you need the money, and the money comes from the mortgage lender. And here, I'll move us all side by side so we can see the bottom of the page here. Oops. What just, oh no, I opened up my Apple TV. That's not what I wanted to do. There we go. Sometimes when you have the error, there we are. So, but you need to go to a lender. So what happens is when you're being lent money, the idea of what the interest is going to bring in today, let's say your interest rate was 3%. Well, 3% is going to buy, let's say, a steak sandwich, right? But yet when inflation, that steak sandwich becomes more expensive. So the 3% that you get on your money today may only buy a half a steak sandwich tomorrow. And that's why inflation and oversimplification is bad for rates, because the rate of return on interest is actually worth less. It has less buying power as the cost of goods go up. And that's why you see an inflation issue, and inflation is kind of that main thing. Now, the second thing, was it not? Let's see if I can't get this to. There we go. Okay. So the second thing that helps mortgage rates go down is actually a fear of recession. And a fear of recession, even though that's not good for the economy, it's not good for jobs. We don't want to see a recession necessarily, but a fear of recession and the idea of a recession itself, it's actually going to help mortgage rates come down, because the Fed would have to stimulate the economy and businesses have to kind of stimulate growth. So the cost of borrowing money goes down during a recession. So we've had two main drivers in the last, couple of months that have really, or actually it's been much longer for the fear with inflation, that have driven mortgage rates where they are. So this year in 2022, mortgage rates went from all-time lows to not all-time highs by any means, but much higher than we've seen in about a decade. Michael, how long have you been in the mortgage business?
5 years.
You said 5 years, right? And Rodil, how long have you been in the mortgage business? You're muted again. There you go.
Since 2005.
Okay, so you've been in there, and I've been in the industry for about 22 years now. Last time I remember seeing rates in the sixes and sevens were in the early 2000s. Does that sound about right to you guys?
Yeah, I want to say it's been, wow, maybe 2008, something like that. Maybe.
Yeah, I don't even know if rates even went up that high yet. Then, so it's definitely it's been a long time. So and inflation that we've seen being at above 8% this year has driven rates higher. It's driven the Fed to raise interest rates, and the Fed doesn't directly control mortgage rates or even your other consumer rates, but they do control the Fed funds rate. And by when the Fed raises rates, that has pushed things higher, and we see rates increase with that fear of inflation because the more we see continued inflation, the more we're going to have to see rates go up to fight that, and it makes your money worth less today. Now, as we saw that fear of recession, that's what we started to see in July. There were a lot of headlines, a lot of articles out there that talked about the recession. The idea was the Fed, they kind of have a lot of control over which way money goes. And the Fed, when they raise that Fed funds rate, it actually slows the economy down, and that's supposed to slow inflation down. It's supposed to reduce demand, which will allow supply to catch up, and then we see things kind of level off. And that's what the Fed has been trying to do. So the Fed started raising rates back in March, and the first Fed rate hike was do you guys remember? I think it was a quarter point back then. I think their first one was just a toe in the water quarter point. Does that sound right? Was
Yeah.
it? It seems like they've just gotten bigger and bigger so fast. I'm just trying to
Yeah.
remember. So it was a quarter point.
Yeah.
And
Back then it was a quarter point at a time,
and then
and the Fed let it
yeah,
run for
and
a
then
bit.
in May they did their first half point, and then in July they did a 3/4 point, and then now we are in September, because there's no August meeting. So that is expected this month, which is today. We're going to talk about today's Fed day. So they're expecting to do another 3/4 point rate hike today. There is some talk that we could see a full 1% rate hike in the Fed funds rate. So this, as the Fed has raised rates this year, that has, of course, contributed to mortgage rates going up. One thing to be very clear, though, is that when the day that the Fed raises rates, like today, the Fed is likely to raise rates by a minimum of 3/4 of a point, possibly even 1%. That's not going to cause mortgage rates to jump 1% today. We're not going to see mortgage rates move higher as the Fed makes this rate increase. We saw mortgage rates move higher 6 weeks ago on the expectation of what would happen, because as things were starting to move along, we had March, May. Oh, there was a June meeting in there. That's of course because we had a June meeting of 0.75, and so these are the different rate increases that we've seen along the way. And just a few weeks ago, markets, investors, they were thinking, okay, inflation's coming into check. We had a decent inflation report come in that things were slowing down. And they said, well, maybe the Fed is ready to slow down on those Fed rate hikes. And maybe September, we'll see 3/4 of a point. And then the next ones that we're coming up to are November, December, and then I think it might even be January or February rather than January, but we'll look on that in a minute. And the idea was, hey, as we get to this, now the Fed can slow down again, and maybe we'll see a half a point. We'll go back down to a quarter point, and then the Fed will hold those rates. And that's the term for this final rate that the Fed is going to hold at for a while is called a terminal rate. And that's the idea of where's the Fed going to cap out? And they're going to hold rates there for a little while so that they can see inflation start to slow down. And then that is supposed to really just kind of get the economy back on track. It'll slow the economy down. We could possibly see a recession. And that was where the Fed was like, hey, we're looking for what's called a soft landing. They wanted to say, maybe we can balance this just right. Maybe we can get to get the interest rates to be in the right spot. Maybe we can get the economy to still do okay. And maybe we can get the inflation to get back in line, and everything will be good. We'll keep the jobs up. Well, then they've gotten a little more realistic, and they said, okay, this whole soft landing thing, it's kind of like jumping off a building into one of those big parachute blow up things there, right? And they said, okay, maybe this isn't going to the way it's going to be. And a few weeks ago at the Jackson Hole Symposium, Fed Chair Jerome Powell came out and he said, listen, this may be painful. We may have a painful, economy as we get inflation in check, but we are fully and solely 100% committed to getting that inflation in check, getting it down. And the Fed wants to get inflation around 2%, and we need to get inflation down, and that's a big thing. So today the Fed is going to meet, and the expectation is that they're going to raise rates by 0.75% or 3/4 of a point. There's a 1 in 5 probability that they may go up to a full point, but it's not overwhelmingly expected. But everybody is going to be looking today to see what is the Fed going to do at those next couple of meetings. We've got one in November, we've got one in December. And the idea that the Fed was going to slow down is now gotten put into the opposite. And we think, well, the Fed's going to have to continue to be aggressive. There's speculation that November meeting will also have a 3/4 point rate hike, and that the December meeting will have a 0.5 point rate hike. So everything's been pushed out, and that's why rates have kind of been higher. So today, when the Fed acts, what generally has happened after the last few meetings, when we've seen the Fed actually, hike rates, because the mortgage market has already priced this in, meaning mortgage rates already reflect the idea that the Fed is going to take this action. When we get that confirmation, it's actually pretty good for mortgage rates. We have seen mortgage rates improve a little bit after the last couple of meetings, and we're hoping to see that again today. But I mean, I have my opinion, but let me ask you guys, are you comfortable putting your opinion out there? What do you think is going to happen today? Do you think rates are going to improve? And if so, how much? Or if worse, how much? Michael, let's go ahead and start with you first. What do you think might happen today?
Well, I mean, looking at, I follow you every day as far as text alerts and everything else. So, I mean, I probably line up more with what you're saying as far as looks like it's going to be an increase in the rate, but increase in the Fed's rate, but ultimately, I think we'll get that reprieve. Hopefully, we can have a few good days of rates kind of recovering from that, and then everybody would be able to lock loans and
yeah. Do you think we'll see rates go back to where they were in July?
I don't think we'll get there. That seems.
Yeah, we'd have to see a whole lot of movement to get there. Rodil, what about you? What do you think today is in store for today, and where do you think that brings us for the next week or so?
So I'm going to go out on a limb a little bit here. Now, I think the Fed's going to increase the rate by a full percentage point. So
you're that 1 out of 5. When they say 4 out of 5
yeah,
dentists agree, you're that 5th dentist.
Yeah, I think it's just because the jobs and economic data for the last month have been coming in hot. So I think the Fed, at this point, they really want to get Americans to get the message before they start spending for Christmas that these costs are going up and you need to spend less. The hopefully good news part of that, I think, is I agree with Michael and you in that I believe once the Fed makes its announcement and raises the funds rate, we are going to see a pullback in the stock market and an improvement in the bond market, because it's going to be a little more than the bond market's expectations. A little more effort by the Fed to slow down inflation, and for our side of the business, that's a good thing. So I'm going to be in that the 1 in 5 who thinks the Fed's going to go for the full 1% increase, and knock on wood, we'll hopefully see interest rates go down, mortgage interest rates go down a little bit in response.
Yeah, and that's probably if the Fed did raise rates by that full point, that would, even though they're raising rates more and people think, well, that's going to cause mortgage rates to go up further, because it's a very strong action against inflation. Like what Rodil said, it should, and I say should, lead to mortgage rates improving even more than if they just do that 3/4 point rate hike, because everybody is expecting the Fed to go up to what we call a terminal rate of about 4.5%. And that's for the Fed funds rate. When I'm talking about the interest rates, we're talking about that Fed funds rate, which is currently at 2.25 and expected to go up to 3%. And actually, let me double check, because I talk about this so often. Let's see. I want to make sure I look at all these things all the time, and I think of the increments in my brain. I want to make sure. So we're currently at 2.25, expected to go up to 3%. And by the end of the year, they're expecting it to be, possibly above 4. So that's where everybody's going to be looking at. And in order to kind of get the information from the Fed, what everyone will be looking at today is the Fed is going to do what's called a dot plot. And every quarter, the different Fed officials, they anonymously peg out where they think rates are going to be over approximately the next 18 months. And so this dot plot forecast is going to be, like it says here on this Bloomberg headline, it's the main focus of investors because they're looking at not just what the Fed is doing at this meeting, but what they think is going to happen in November, December. And this is Fed futures, y'all. This is just some probabilities. What do we think is going to happen at these next meetings, and what are the markets price in? So right now, there's an expectation at this meeting. Like I said, we've got about 80% believe we'll see a 3/4 point rate hike. 1 in 5, or about 20%, believe we'll see a full point hike, would bring us to 3 1/4. They think that rates will be at about 3.75 at that next meeting. Small amount believe we could see more than that by a 1/4 point. Small amount believe that they could slow down a little bit. And this is where we get, if the expectation is that the Fed can slow down in the future, that's going to help mortgage rates today, because we're always forecasting and reacting early with mortgage rates. And the same thing for December. There's expectations that we'll be at about 4 1/4 for that Fed funds rate. Some believe we could make it all the way up to 4.5 by then. By the time we get to that February meeting, though, it's kind of neck and neck, believe, between 4 1/4 and 4.5. And that's really what they expect us to be, what's called that terminal rate. This is where the Fed will likely stop raising rates. And it's still quite a bit higher than where we're at now. The good news, though, is that mortgage rates wouldn't continue to go up and up and up at every meeting. It's if we get to that expected point today, if it's the expectations of today that are already priced in for what's going to happen in the future. So that's why it's so much harder with mortgages, because we don't just wait until the Fed actually raises that Fed funds rate and see it change. We have to worry about what the markets are pricing in ahead of time, because they're trying to react and act accordingly. They're being proactive rather than reactive to those Fed moves. So what do you think, y'all? Anything that you guys want to add to that, or anything you want to, change on the things that you guys disagree with what I said?
No, I think that's pretty good call for what the market's going to do short term. I would like to remind our viewers, especially ones who are looking to buy the VA loan, that there are, at least where I am, the real estate market it's not nearly as hot as it was 6 months ago.
Mm-hmm.
So now we're seeing things that basically home buyers are getting some financial help from home sellers, help with closing costs. I mean, obviously there can be price adjustments, but I think what has a bigger impact for home buyers is getting help with either their closing costs, or sometimes getting money from this home seller to buy down the interest rate, either a permanent or temporary buy down, what in our industry is usually called a 2-1 buy down. And that can really help, at least short term, a new home buyer in basically being able to afford the interest rates, especially where they are right now.
And then, so there's a couple of great things to talk about there. And Michael, let me ask you, in your market, are you also seeing that home prices are maybe stabilized? Do you think it's a great time to buy a home? Is it an okay time? Is it a bad idea? What would you say from both a real estate agent point of view as well as a mortgage point of view to should somebody be looking to buy a home now, or should they be anxious?
Well, I probably lean towards the investor side of things as far as risk. So I'm a person that would say now's the time to buy all the time. So if rates are going up and you're seeing the prices stabilize, which is what they are doing in our market as well, I wouldn't say they're going down, but they're definitely stabilizing. By doing that, that's allowing for the buyers to come with a different mindset. And by having that different mindset, it allows for closing cost coverages, whether it's concessions. I actually showed a house to a couple. The agent afterwards asked how it went. I told them they loved the house. The agent within 30 minutes came back with, my sellers are willing to give you $10,000 just if you want to buy down the rate, because the rates are so bad, everything's going sideways. Like, they're really trying hard to create some movement. And it's just a different market, certainly, than it was a year ago, where you're way overpriced and that kind of thing.
Multiple offers, bidding wars, people paying. It was driving the cost of homes up too fast, and we knew that was unhealthy. So, but are you seeing big reductions to price necessarily, or just now things have kind of stabilized and maybe some of those price concessions?
in the Nashville market's pretty much stabilized. I mean, there's been a few houses that I've seen that were doing some reductions because they have been sitting for a while. But Nashville's a little bit hotter market, so we're still seeing increases overall in our area. So I wouldn't say that there's huge reductions unless it's a house that maybe needs some work, and or maybe the sellers had overpriced the house when they listed it.
So would you say that we're in a housing bubble, or do you think that, because again, a housing bubble implies the idea that home prices have gone up way too high and then it's going to pop and they're going to come back down. So that's the idea that home prices have come up here, that's going to, of course, pop. This is my idea of a popping bubble or a sun, and that prices will come back down, and, everybody that bought here is going to lose money. Do you think you're in a market where we're in a housing bubble?
No, not a housing bubble. I wouldn't even say almost a flattening, not even a flattening. It's still going to have an increase year over year. So this is the other part of what you were just asking. I would say buy today, because next year, just across the board, we're still going to see house prices go up because they naturally do. The cost of a house, to purchase a house, cost to build a house is still going to continue to go up. So there's still going to be that increase in value that happens year over year. By doing that, if you buy next year, what you were buying today versus next year is going to cost you more, and you may not be in a better interest rate situation next year. We don't know.
And then, so let's talk East Coast, West Coast, like the rap battle. So, Rodil, give us that West Coast version. What about for your market? Do you think we're in a housing bubble? And what are you witnessing out in that way?
So, as I mentioned, I'm in the San Francisco Bay Area, so close to Silicon Valley, or as I call it now, social media valley, with Facebook and all those other giant companies. So, I'd say it depends on how home sellers are pricing their homes. If they're pricing them close to market, they're still seeing some price appreciation, or it depends on how on their specific neighborhood. I mean, our market has been so overheated for so long, even room temperature feels really cold. So when I'm talking to home buyers here, I simply tell them, look at and this kind of goes for anywhere in the country for your local market. Look at jobs, rents, population. Are they going up or down where you live or where you want to live? Here, companies are. I mean, there are some companies that are cutting back, but companies are still hiring. Rents are still high. A lot of people still want to move to the San Francisco Bay Area, and that I think is going to keep home prices high, or at the very minimum, if there's any kind of downslope, it's going to be a very, very one, barring some black swan, completely unexpected event.
Right. Yeah. So similar thing. And I think I'll throw this up on the screen and you guys can see it as well. I think everybody needs to recognize the difference between deceleration versus depreciation. And home sales have decelerated. Home prices are decelerating, meaning they're still appreciating, but at a slower, I want to say, more normal, more healthy rate. And we're not really seeing true depreciation in most markets and in most price points. And I'm clear about that too, because you've got different price points. You've got, the first time buyer starter home price point. You've got move up buyer price point. You've got a more, I don't want to say a more wealthy, but, wealthier kind of higher end price point. And they all react differently depending on that demand and in the particular market. But overall, great example, my daughter, her fiance, they're buying a home in Charlotte, North Carolina, Open Door. This was something I threw on my Facebook page just a little while ago for everybody. Open Door bought this house sight unseen in May for $296,500. This is Open Door is what's called an iBuyer, for those of you that may not be too familiar with it, where they're making offers based on algorithms, computer-based algorithms, on what they think the value of a home is and what that home was going to appreciate. And basically they were riding the market of, hey, we can buy this house in May for $295,000 or $296,000. And they then listed it a month later after doing some paint. They smacked some paint up on the walls, they changed the shutters, they refinished the floors, so they put a what I would say is they put some lipstick on the pig, and then they put this thing out there for $327,000, or about a 10% profit. The problem is that market was starting to slow down a little bit, and they weren't really taking into account that this is, although the house has great potential, it's a house that's got dated features on it. The windows are from the 60s. The house was built in the 60s, and it's got, things that need to be updated. So the 327 worked its way down every couple of weeks. They kept dropping it $4,000. Eventually in August, my daughter and her fiance put in an offer for $300,000. And Open Door would have basically picked up the house and sold it and made a few $1,000s in quote unquote profit. And instead, they found a couple of issues with the home. And I said to them, hey, listen, put in a request to lower the price by 20,000. And worst case, they'll counter offer, or they'll tell you no. Maybe they counter offer and tell you 10,000, or maybe they're just not willing to negotiate. Well, wouldn't you know, just to show where the market is, they gave them the 20,000. They reduced the price by 20,000 because Open Door wants to get rid of that inventory, because they recognize that they're not in a market where they can just throw a coat of paint on a house and make $20,000-$30,000. And that's good, because nobody should be in that. In my opinion, you shouldn't be making $30,000 for not really making any true updates or changes to a home just because you bought it and the market appreciated that much. That kind of appreciation is just unhealthy. It causes a market where nobody can afford to live. So now that started to settle back, but the reality is that the house is priced appropriately now, and they got a good price. And if they're getting a mortgage rate that's higher, well, is now still a good time to buy a house, guys, with the mortgage rate being higher? And if so, why? So, Michael, why would you counsel people? Yes, rates are higher, but why should they still buy? And then what would their options be in the future, especially for VA members?
Well, from a equity position, they're obviously going to have a better equity position in the future by buying now, buying lower. As far as should they buy now, yes, I think interest rates are constantly moving up and moving down. Hammer, you've talked about that, where you look at the 20-year average, if you look at long-term data, this is almost a little bit higher, but almost normal. Like, this is the range we hover in. So I think this is definitely a good time to buy. And then, look at it a year from now, 2 years from now, you see the economy bouncing back, you're going to see rates come back down. That's a great time to refinance. For a veteran, the VA IRRRL is in play, so it's a lot less expensive way to refinance your house, and it's a lot less painless too. So that's something that can happen, and VA IRRRL rates are usually a lot better overall compared to mortgage rates. So
yeah,
I mean, that's just definitely a good time to do it.
Rodil, tell us a little bit about the VA IRRRL. How long, if somebody's buying a home now, what does an IRRRL look like? How long might they have to wait, and what would they be waiting on?
Oh, I'm sorry, I dropped out for about 5 seconds. Was that to me?
There you go. Yeah. So
okay.
That's to you, man. So tell us about an IRRRL. What are the requirements? How long do they have to stay in their loan? What would they be looking for if they're buying a house? If someone were to get a rate today of let's just say 6.5%, and rates drop down, what would that look like for them in a year, or how long do they have to wait? That kind of thing.
So veterans using a VA home loan have access to, as Michael mentioned, the interest rate reduction refinance loan, or since that's such a mouthful, we call it the IRRRL loan for the acronym. So what that allows veterans to do with this loan is refinance their home to a lower interest rate with a very low paperwork process, much lower cost for doing a refinance compared to conventional and other type of loans. The requirements is that the homeowner has to make a minimum of 6 payments on that loan, and a rule that was put in a while ago to protect the veterans is that the rate has to drop by at least 0.5%, and there's a calculation that has to show that the veteran can recover their closing costs within a certain maximum amount of time for the VA to allow this loan to be done. So
right.
Basically 6 months, have to drop the rate at least 0.5%. And then, so for veterans who are looking to buy a home and they think that interest rates will drop in the future, or even whether they think they do or not, they're in a better position than most homeowners to take advantage of rate drops after 6 months.
Yeah. And so everybody, and remember, the reason that plays out now is there's basically there's a little picture I've got up on the screen for y'all, and rates are on the left side, prices on the right side. When rates go up, as you can see with this blue line, affordability is the center focal point. And affordability, when somebody says, hey, I can buy a home and I can afford $2,000 a month, well, if the interest rate goes up, the price has to adjust so that the payment comes in around $2,000. And if the interest rate is higher, that means the price of the homes can't keep going up. Now, again, doesn't mean they're going to come down much, because we still see a strong demand, but it means that they're not going higher and higher and higher. So that is why buying a home now, as prices have stabilized and you're getting maybe some concessions we've talked about in past weeks, this is such a great time to jump in on a home purchase, because when rates do drop again, and I do definitely think they will, what's going to happen is the Fed is likely to push the economy into a recession in order to stop inflation. And once that happens, the Fed right now is in a rate rising environment, and they will have to go back into a rate lowering environment to resuscitate the economy. They're basically choking the economy out right now. And when they get it on the verge of death, they're going to have to resuscitate it, give it some CPR. And that's when they're going to start lowering rates again. Mortgage rates will also go down at that time. And when those rates do go down, well, you're going to have a lot more people that are now pent up demand, and they're looking to get out there and buy houses again. And what that's going to do is create bidding wars and create, more demand than supply. And we're going to see prices go up faster again. So that's kind of the way that in a very simple world, way the process works. So buying a home now when prices are good, but rates are not as good, but yet having the ability to get out of this interest rate in a few months, and 210 days, 6 months, and saving that 0.5% in interest rate. Now you get the best of both worlds. You bought a home when prices were stabilized, and then you can take advantage of better rates later. Of course, you should never buy a home with the idea that you can't afford it unless rates go down, because there's no guarantee that rates would ever go down. But it is, again, forecasting. We do think it's likely. I think it's likely, and I've shared why. And that's kind of it. So anything that you guys want to add, as far as any good tidbits for consumers out there, what they should look for rates for buying, anything, Michael, that you'd like to add?
I'd say just make sure you're checking, shop around, make sure you're getting the best deal. There's all kinds of loan officers at multiple different types of lenders. So there's definitely a way for you to shop and get the best deal. Asking your loan officer,
Yeah,
what, is there a better deal? Is there a different way that we can look at this so we can buy down the rate, or can we, what can we do that is going to put us in the best position to buy?
And I think Nathan had a live on the Facebook page here, y'all. If you guys look around, I think they had a live not too long ago about how to shop around and the best practices in shopping around. So that's great advice, Michael, and people can get more info on that if they go back and watch that recording. Rodil, what about yourself? Anything that you want to leave everybody with?
I'd say speak to your loan officer and make sure you're comfortable, and that they're doing a good job of explaining the full home buying process from their side of it. Obviously, for the real estate side, they want to talk to the real estate professional, and also make sure you're fully pre-approved before starting the home buying process, because the real estate professional is going to ask them to do that anyway. And this way, and when I say fully pre-approved, that means they've actually sent all the paperwork that a loan officer is going to need, or I should say what the loan underwriter, because that's the human who says yes or no to the loan, is going to need. And that puts them in the strongest position to buy and not have any surprises in the future.
Awesome. Well, Rodil, Michael, thank you again for joining us. Remember, everybody, we do this every week to discuss mortgage rates, 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. We do this on Wednesdays. We'd love having you here. If you did watch us on the replay, do me a favor, give us a hashtag replay. Let us know that you did watch. If you're here live and you haven't yet, say hello to us. If you have any questions, put them in the comments. We'll be glad to answer them for you before we go. But otherwise, I think we're good to wrap it up. And thank you again, gentlemen, for joining me. I appreciate it. And y'all have a fantastic day. You guys can stay on. I'm going to hit end. You don't have to hang up yet. 1 second. So, all right, everybody.
Have a good week.